Hello, and welcome to Mornings with Joel, commercial real estate podcast, where we focus on rising stars and established players in commercial real estate and talk to them about how they are building legacies in today's marketplace. I'd like to welcome all. This is the Mornings with Joel, CRE podcast. And we've got a longtime friend of mine here today, Charles Frazier, my homie from, we've known each other for a long time now. And it's good to see you, man, as always. Happy to have you.
Likewise.
Yeah, good to have you. So it's been an exciting run. I remember us talking back during the recession about how, it was time for really I was talking about the younger generation, which included us, back at that time, trying to, make our stake in the world and accomplish some things. And I want to congratulate you. You've done quite well on some of your projects as of late up in DC and whatnot. So congratulations on that.
Thank you.
Yeah, and I know you got a lot coming down the pipe as well. So before we jump into that, as always, what we do is just go into a little bit of a background as to how you kind of got rolling into the CRE space. From what I understand, you pretty much came right out of school into CRE and kind of got, you came out like a rocket ship, pretty much knowing exactly what you wanted to do and hit the ground running. So is that a safe assessment?
That's pretty much it. You want me to go into that now?
Yeah, please, if you don't mind.
Okay. Well, look, let me back up for our guests and just again reintroduce myself. I'm Charles Frazier.
I'm sorry, Charles.
No problem. Managing one of the co-managing partners with Gateway Merchant Banking, and we are in the multifamily housing production business. We design, build, and finance multifamily apartments in major MSAs in both high growth markets and in core markets. Have developed about 2,500 units of multifamily housing. We have a current pipeline of 803 units, and my partner Terrence Murray was on the finance side with a variety of debt and equity institutions. Joel hit it on the head. I came out of college I was in college in the commercial real estate business. I had a teacher. I grew up in Chicago. Had a teacher that said use OPM, other people's money, and said buy property. So I got to college and in the early 90s. And fell into the student housing business by owning 9 townhomes, which had 4 bedrooms and 4 bathrooms in each one, was renting out each bed for $300. And the place was at 50% occupancy when I bought it. And obviously I had all my friends at Florida A&M in Tallahassee and took it immediately from 50% occupancy to 100% occupancy. I got my first equity investor as my other people's money, as my parents. And they were public school teachers in Chicago, so they had security from a pension standpoint, but not significant liquidity. What we did was we used a home equity loan on my first purchase when I was a sophomore, which was my residential house. Same concept, lived in 1 bedroom, rented out the other 2. And that produced probably about $20,000 of home equity. I guess it was a good time because we built the house. So we built the house, $20,000 of equity there. And I got another 60 from my parents. They had an annuity. The return on that 60,000 was guaranteed because my brother ended up owning one of the 9 townhomes. And so that put him as a resident of the state of Florida. So the tuition differential justified their investment. And I was 21 years old, renting 36 beds. And that led to then what became a commercial development. I was with Tom Joyner's son, Oscar Joyner. He was at Florida A&M in the business school as well. The student housing business was starting to take off. You had a lot of housing being built at Florida State University, not a lot of housing being built across at Florida A&M University. And I fell into the development business at 22 years old.
Wow.
1998.
Impressive. Well, keep going, man. The story is good. I'm sitting back enjoying it.
Okay. All right. So then what? So Don Peoples was on yesterday, right? Talking about Affirmation Tower. And he said, when you owe the bank $500, $5,000, they sleep and they come after you when you owe them, $50 million, then all of a sudden they become your partner, right?
Yeah.
And so that's effective. That's exactly what happened with falling into that real estate development because the architect and the civil engineer would then had a vested interest in us being able to complete the project. So we, after a year and a half, a lot of roundabout, we got it done. Learned how to finance it with the use of tax exempt bonds, and created a pretty solid joint venture. We got our capital back, made some good money, probably created $2.5 million of profit, which we participated in. And then the project opened up 100% occupied in 2001.
Okay.
That kind of led down the road of starting with historically Black colleges. We did what we knew, including what I consider, I probably should publicize it more, but I'll go to Houston next. So in Houston, Alfonso Jackson, so former Secretary of HUD, was there. He took a mentorship perspective. Texas Southern University was issuing an RFP. We end up doing student housing there together. These are off-campus apartments, anywhere from 100 units up to 200 units, and then you multiply that out to get the number of beds. But effectively, they're apartments. Then went to Jackson, Mississippi. I'm not going to go through each deal. We got 13 of them. But Jackson, Mississippi, and I kind of like that one because we tore down a cottonseed mill. So there was a cottonseed mill adjacent to Jackson State University, 7 acres. The campus was only 100 acres. So we actually bought that land, contributed to the university, and built apartments with the use of the bonds, and then gave it to them on the CD. They had a community development organization. Texas actually took me to the market rate side of the business. We started at historically Black colleges and then realized that there were other underserved markets. So, one example would be Mississippi State. So all the capital, the wealthier students were at Ole Miss. So you had new apartments going in Ole Miss. You did not have new apartments going to Mississippi State. We partnered up with actually a local group there in Atlanta, Builder Wood Partners, who basically was not only a builder, but had access to capital as well, cheaper capital than we did. We developed 828 beds there, and then with the same group went down to Texas A&M Corpus Christi. Instead of doing just a university transaction, there were other demand drivers, which included a naval base as well as a solid employment center. So we realized, why just do purpose-built student housing apartments, do market rate apartments? Did that, sold it to Camden. That was a success, and then we started talking about the recession, because then the recession's coming around. Yeah. Take a pause on development. That's kind of the track record pre-recession.
Yeah. So let's pause there for a second, because that's pretty exciting, and you've been able to cover a lot of ground. One thing that I found over the years somewhat challenging is sometimes getting through the way HBCUs think and operate and function when it comes to getting things done. Why do you think you've had so much success working with HBCU? You said you've done 13 deals.
No. Only about 4.
Okay.
Four of the transactions were with historically Black colleges and universities. But what we recognize is, we're really just looking for landowners in emerging markets, right? So you got universities, you've got churches, and you've got, families that often are, have an emotional mission kind of tied to property. And so we leverage that in redeveloping that property. I think that, you just got to work through things, and we just stay going forward, arrange your capital, execute well. And I guess that's how we got them done.
Mm-hmm. Okay. So how would you say, what was the formula because some of our listeners might want to work with HBCUs as well. What would you say was the formula to opening up those doors and actually being able to get something accomplished?
I think when you're dealing with anyone, whether it's an institution or people, I think at the core is trust, trust and performance. And so that's what it is at the base. And then the other part is with institutions, we found it important to deal with leadership. And sometimes leadership isn't who you think they are. Mm-hmm. So you got to figure out who is leading and can make decisions. And usually you get a decision maker plus trust plus performance, and you get to a positive outcome.
Okay. Well, that makes sense from that standpoint. What do you think the opportunities are for student housing development? And we're going to talk more about multifamily, because I know how you pivoted over the years, but what examples do you feel exist today for someone if they wanted to get into student housing development?
So not in the market currently around the student side. What tends to happen is is that it is very easy to quickly overbuild a market, and so then you end up having too much supply. If if you've got a university, let's just say, for example, 25,000, which is a fairly large university, not a lot of them at 25,000, and you have demand. Well, okay, so one person builds 500 beds, another person builds 500 beds, and you got two or three going at the same time. And all of a sudden, you go from a supply demand balance need to oversupply. And that makes it very hard to execute. Also, the business started to institutionalize, like all real estate, as more capital poured into the business. Then the participants were the ones that were better capitalized with larger capital, effectively building the own for the longer term, which then changed the way you had to finance your deals. But I think the better way to characterize is back to basic fundamentals of supply, demand, and location.
Okay, all right. So that pretty much answers something I was going to ask you about. Because interestingly enough, one of my bankers came to me the other day and said, "Hey, we got this deal on our books, and it really needs to be sold." And we kind of went through some details, and it's a student housing deal. And without getting into all the details, the question in my mind was, well, do we make a run at trying to buy this thing, or do we let it go? And I'm not really have a big background in student housing. I know that's been your space for a long time. Any initial thoughts on, or would it just be the same fundamental conversation about supply and demand and everything else?
No, it's just math.
Student housing.
It always comes down to math. And if the market, if they're underperforming on rents, if they're underperforming on expenses, if they're not driving their traffic appropriately. But the one thing you never can solve for is location. So if location's bad, then you just got to underwrite the reality of that location. And then the physical property, it's almost like there was an arms race in the business where people would just build a lazy river, right? Like a resort lazy river. And so it's moving away from the fundamentals of supplying housing to supplying something else, hence our pivot, call it in 2005. So we were pretty active. I think I did 5,068 beds from 2000 to 2006. And then since then, pivoted to the market rate side where, you got sub markets with, significant opportunity as opposed to just one university.
Okay. So that was really the core reason for the pivot, was just greater market opportunity.
More. And really it was just, I was doing what I knew, right? I was a student. Yeah. So I was a student developing student housing, but really developing apartments that were near universities. And that set up very well for learning how to execute in a variety of markets. We did 7 different states, probably 13 separate markets, and really learned how to go into a market, understand it, execute, and source opportunities in other markets.
Yeah, gotcha. So let me ask this: as it relates to the pivot to multifamily, would you focus more on I know you're doing development, so I'm not going to ask about acquisition, but what about affordable versus market rate? Where do you see those opportunities lining up these days?
It depends on how people define affordable, right? So affordable can be all the way on one spectrum, low income, very low income, which call that 30% AMI, highly subsidized housing, public housing, et cetera, and all the way up to, workforce housing. And in some markets that, the term affordable and workforce could be at 150% of AMI. I mean, somebody making, $100,000 a year, right? And so I do think that the market demand, back to that supply demand fundamental, as housing is just fundamentally undersupplied because of housing production, that there's probably more unmet demand at that 80 to 120, 150% AMI, which tends to not say I'm going to the luxury spot, the luxury main locations and building the A+ product, but maybe it is a few less frills and a slightly lower land basis and not going high rise. So I think that the demand is huge on that workforce side. The affordable side is really a function of government and what subsidies and the political will, both locally and federally, to subsidize and fund that.
Yeah, yeah, gotcha. So quite interesting on that. Let me ask you about this also, just to get your opinion on it or how you would define this. Now, I know the answer to this, but it's mainly for our guests and our listeners. What is really the value of these relationships? Like you said, you look for it might be church, it might be a university, it might be a family that owns a ton of land. What's really the value of that as it relates to getting into a development deal that you've seen over the years?
A large developer just said, "Bring me." It starts and ends in the development business with a site.
Mm-hmm.
That's it. It's just site control, and it's understanding who owns that site and what their interests are, and do you add value to their interests of that site?
Mm-hmm.
In most cases, it's money. The only question is it 100% money or is it money plus something else? And in the development business and in neighborhoods and communities, very often it's money plus something else. You could have unlimited money and still be unable to develop what you want. And so it is demonstrating an ability to solve that, understand what that something else is, and then demonstrating and communicating and then doing, right, the execution of it.
Yeah. What about JVs with current owners?
We do that, right? We do that where owners, I think it's inefficient for people to sell property, pay taxes, and then go find another, investment to put that property into. Put that capital into, because on the flip side of that, we go and raise capital from investors, and then those investors are making usually solid mid-teen returns, approaching 2x multiple on capital, doubling their money probably for 4-year, 5-year investment cycle. And so that makes for, a compelling case to a landowner that has equity where we think is more efficient. So we've done that a couple of times as well. This project I'm sitting in right now, virtually, was called Trellis House in Washington, D.C. We did exactly that. The landowner had property next door to Howard University. We gave them half the capital in cash. We took the other half as contributed equity. That gave us control of the dirt. We then were able to take underutilized residential lots that the university had and help them monetize that, combined it on a ground lease, and then worked with the community to build what would have been, call it 80 apartments. And then, what we call a strategic approach to development took that 80 entitlement up to 319 units. And that was done in a combination of addressing the needs of the new community, right? So they want dog washes and LEED platinum buildings, and that's what we did. Made that part really nice, but also we recognized the changing community, and we went in we exceeded the inclusionary zoning, so we built more affordable housing, because to get your zoning densities, you have to include you have to do a minimum of 8%, 8% at 80% AMI. So see, that word affordable is tricky, right? Because then some people came back and said, wait a minute, it's affordable, but they call this inclusionary zoning affordable, but what's the rent? Well, the rent's $1,600 instead of $2,000. And so, some people were like, well, that doesn't qualify for what we wanted. But long story short, we were able to structure where we gave a part of the excess affordable that we did, inclusionary zoning, to special use by the university, so that university faculty, staff, graduate students could get first dibs on that housing side. And then we also were creative with, unfortunately, a lot of our institutions or a lot of these emerging areas are near housing projects, as the way that our communities developed out a lot. And there's opportunity there because now those communities are close in, and for a lot of reasons, infill development has a lot of demand. We recognize that people didn't just want to fish, but teach them how to fish. Like, I want to be able to stay in my community. And that came down to you have the income to afford the new prices in the community, right? And that was, we moved towards skill training and just said, hey, instead of just throwing another, $500,000 at subsidy that goes into the abyss, we dedicated that to a job training program. We partnered up with the University of District of Columbia. Ron Mason, actually the president, he was the president of Jackson State when I tore down the cottonseed mill. And so he had faith in me at 24. So this was probably 24. I guess at that time I was probably I must have been close to 40, definitely late 30s. So it was at least a good 10, 15 years later. But teamed up with them and for the HVAC training, effectively, after a year, someone could be in a position to earn $40,000 to $60,000 a year, which, now with a two household income, you can afford to live in this new community. So that was another aspect that we did, which really brought a lot of favor with the community and embrace of a project.
All right. Actually, that's really cool, to be able to do something like that because you're not just building the building. People always have a funny view toward developers coming into their neighborhood and, making all this money and leaving and going back to Florida like yourself, right? So, but to be able to do something creative like that is impressive, where you're giving people the skills to have a job that basically can qualify them to live in the property.
Yeah, the carpetbagger mindset does creep in. I do hear that, but look, we're leaving behind $3 million every single year in Washington D.C. between property tax income and income tax that the residents pay. There are, some 350 people that were not living in the District of Columbia that are there now. The tax receipts probably went from, under $50,000 a year to probably $1.2 million per year.
Right.
And that just keeps going every year.
Yeah. Yeah,
I would gladly trade spots.
Yeah, exactly, right. So you let them know that, hey, we all bring the value here for the long run. So that's good. That's really smart. So appreciate that. Well, one thing we want to do, we want to go ahead and start opening up the line to take your questions. So if you do have a question, you can raise your virtual hand or put your comments in the chat, and we will, entertain those as well. So we look forward to that. So tell us about this as we're waiting on those comments to come in. Was that your most recent project? I know you did a project recently in DC that was sold off to CIM, who actually right now is doing Atlanta's largest project downtown. Was that the same project or was that a different project?
No, that was it. And then we sold it. We sold it to CIM Group, large pension fund manager, and they got it. It was really good to work with them on that. I think they understand the same development approach and story that they're doing in LA, Atlanta, and other places. Mm-hmm. So it's a good exit.
Yeah. Well, that is real good. Terrence was telling us a little bit about that, and quite an impressive deal. So congratulations on that.
No, appreciate it. And just to tell you what else that deal did, mm-hmm. right, was we realized, it's easy to get, the average transaction check was, my first transaction was 10.1 million. They got up to about 25 were the deals, kind of pre-2006, right, pre-GFC. Whereas now on the multifamily, housing production side, these deals are probably starting at 40 million. And going up to 90. And so what we realized was that a lot of people are catching deals, but then don't have the pre-development capital, right? So that might be $2 million, a couple $1 million of pre-development money. A lot of times there is a lack of the GP investment, right? So the equity investor who writes a $30 million check is going to want you to put $3 million in, right? Mm-hmm. And then the guarantees to the lender, even if you're financing it, as low as 60%, only going to 60% leverage, that lender still is going to be, you're going to have the balance sheet support. And what we did in the DC transaction is we paid somebody for that, right? And we realized there's a big hole in the market, mm-hmm. where what we created in Gateway Merchant Banking was formed a partnership with our architect and our contractor to then be able to deliver the pre-development, the GP capital, and the guarantees, so that when people do have these sites, it just adds to our tool belt, which then as people bring us transactions, like I said, in either those high growth markets, I'll call that Nashville, Atlanta types, or your core markets inside DC, LA, et cetera, we have the ability to execute.
Yeah. Well, that's a very powerful point, Charles, because the biggest issue that's always faced, especially with minorities, is that co-development or that development capital, that pre-development capital. And that's where many folks fall down is, how do we actually get that money in the door? So the idea of being able to form those relationships with those institutions, and that keeps them committed to the deal as well, from a GC perspective or from an architectural perspective, in order to help finance the project. So Appreciate you bringing that out. That's a very good point. One thing I want to ask before we start taking some of these questions, and we got a few of them that are lining up here. Why merchant banking? Why have you defined yourself in that category? There's not a lot of firms that call themselves merchant banks. So,
well, if you look at the history of what merchant banks were, they would not only bank a transaction with other people's money, right, or institutions' money, but then also co-invest and make a principal investment alongside. So that's the business, and it is not 100% in the development lane, whereas other organizations might be we're a developer or we're an operator of housing, and that's not the case. What we're doing is we are matching a hole in the market, supply demand, as well as service, as you say, the pre-development or the GP capital investment, and matching that, and by making that match, we end up winning.
Yeah, very good, very good. Yeah, go ahead, Christian. He had a question about your formal title.
Yes, sir. I'm again. My name is Christian. I'm new into the CRE field, and I know that you've done a lot of work. So, congrats on that. But I was unsure about the formal title.
I'm managing partner.
Okay. I understand. Again, I'm new to this, so I'm just here for the learning.
Okay, no problem. No,
right,
managing. You'll see managing partner. You'll see principal. Some people, as different sorts of titles and names with organizations. Some people still go with president. It's lots of different groups.
Can I ask one more quick question?
Yeah.
Briefly. Go ahead.
Yes, sir. Very briefly. I know that you have agents and then you have brokers. Would a managing partner be right above the broker?
Well, the brokers tend to go to market, whether it's they go to market for someone who has a property they want to sell on the commercial side, and obviously the larger brokerage shops, leverage their data and relationships to provide that service, and they get paid very well for it.
Understood. Okay. I appreciate that information.
I appreciate that. Just to add on to what he was saying, the broker would really be related to the real estate agent that, like Charles mentioned, go on the market in order to execute on a transaction. Charles, in his place, is actually doing the development more as an owner, and so he's the managing partner of that group doing that development. Okay? So thank you for being here, Christian. We certainly appreciate it. Let's go to Kevin right quick. Kevin Williams.
Hey, Joe, good morning, and thank you for taking my question this morning. Sure. Very interesting discussion, a lot of information. Charles, I appreciate you for sharing it with us. Question I got, being an HBCU graduated from Prairie View A&M University, I heard you mention some deals and activity happening down around the Houston area. From what I can see, what I've seen, the disinvestment around HBCUs, most important development phenomenon is right next to white flight that we've seen in the 60s and 70s in terms of what it does and the opportunities that it's created. Would like to hear you speak a little bit more about two things. One, as capital flows into institutional capital flows into the student housing around HBCUs, your experience with select product. So for instance, in Prairie View, they've got student housing just for students that are making 3.0 and above, which tends to attract, your engineers, your STEM grads, and what happens there. And then also the relationship you've been able to build. You mentioned it briefly with the president of Jackson State and how that leads to more development services with the university.
I'll do them in reverse order. So relationships and services with universities can be a very complex endeavor. I would just find a business where there is demand. Niche, I always look for niches where there is some unmet demand, and then you are supplying whatever's not there. Not so much the relationship side. The relationship side just provides an entree, right, and an opening door to supplying the unmet demand. So then back to the disinvestment, and I'll take it in a couple of pieces. Where do you live? Are you in Houston or?
No, I'm in Dallas now.
You're in Dallas, okay. So I was trying to find a way to give you a good example, but around our institutions and communities, the reality is if you're going to build new housing product, it costs you the same $200,000 to build an apartment unit absent the land, right? Whether you build that in an emerging market or a core market. And the only thing that enables you to do that, for example, this one here, the DC project was north of $300,000 per unit. And so a lot of times our communities don't have the income to do that. You just don't have a deep enough demand for it. So you got to balance it out. Now, Prairie View was very good in balancing that out, with the right partner. They have the largest REIT in the country, American Campus Communities. That's how they kind of started their business on several opportunities. But also universities are not in the housing business. They're in the education business. And so I'm sure that they subsidize the cost of that new housing, but in subsidizing that, plus the federal subsidy of student loans, is they're able to drive their education business, hence 3.0 and above, which then gets better talent. So I hope that kind of answers your questions, or directionally, they're solving something else, not just a real estate issue. Because if I'm building a new apartment and you got to pay, $1,500 a month for that for 12 months, that's a pretty big check. Yeah, that's what, $18,000. You have to be a pretty big check every year.
Yeah.
Very good. Thank you. I appreciate that.
All right. Appreciate it, Kevin. Thanks for being here this morning. Myra, let's go ahead and get your question.
Yes, thank you so much. Yes, my question is for Charles. Do you find that a majority of your current projects are mixed-use projects, with the housing and retail? And if not, what decision process encourages like a traditional apartment, like student housing development, as opposed to the mixed use?
So for mixed use, the one here in DC was a mixed use. By code, we have to do mixed use in one of the projects we're developing in Largo, Maryland, Largo Town Center, but it's only 1,500 square feet, which would be coffee. The best answer to that is a retail site for mixed use to work, i.e. retail combined with residential, is it has to be a retail site first. You can't take a residential site and then try to force it to be a retail site, because the retail will not survive. And retail is about visibility. It's about traffic, so that then the tenant is able to make enough money in both their business and generate, enough customers. So for us, we focus in on the multifamily investment, and we only do the add in the mixed use as a, less than 5% of the total cost, but it could have a role in making the place. For example, we don't have any of this size, but if you have a Whole Foods downstairs or a Trader Joe, you have created a different place for that residential experience. When you have, the boutique coffee shop that makes their own coffee and has a reputation and following, those are things where you can get into the mixed use and make a place better, because that is your front door that people are seeing, as opposed to an apartment or your community amenities on that first floor.
Thank you so much.
Okay. All right. Myra, thank you for being here today and participating. We appreciate that. Uriah, what's up, Uriah? Good to have you back as always.
Hey, good morning, everyone. Mr. Frazier, thank you. Thank you for the insights. I wanted to ask you, you mentioned earlier about the efficiencies with establishing a JV with landowners as it pertains to discovering what their needs are. And in many cases, it's beyond just money in some cases. So I'm curious to know if you can provide some pointers on how to best position a JV to a landowner, and what are some of the terms that should be considered as part of that deal to persuade them to participate as a JV partner?
Sure. I can go down a whole lot of roads, but I'll give you the easiest answer. Listen. Right? That's it. The answer is listen to what they want.
Yep.
And that's it. And then you come back with a structure that after listening carefully what they want, and they may not know what they want, right? What they say may not be actually what they want, 100%. And so I think if you listen carefully, then you can come back and solve and present them with a solution that makes money and market rate sense for you, right? You're, on the capitalist side, and then also makes sense for them as you have listened to addressing their issue. And usually it comes down to money, time, and then maybe some other stuff. But usually it's money and time. Money, time, and risk.
Got it.
Okay. Any follow-up to that, Uriah, or is that good?
Would that also pertain to persuading both the contractors and architects to participate as partners as well? Would that be along the same lines, or would that be a different approach?
It's really, I mean, look, we're paying them, right? So it's not like we're convincing them to to do us a favor. But what is important is back to that demand and performance, right? So you got to first, is there demand? And then after that demand, is everybody going to perform? Because nobody wants to waste their time.
Got it. Okay. Thank you.
Okay. All right. Thank you so much. Glenn Gray, what's happening, man? How you doing today?
Good morning. Good morning. Thank you, Joel. And thank you, Mr. Frazier, for sharing your insights this morning. My question was about your organizational chart. I'm very curious to know, how do you round out your organization? I know on your website, it's yourself, your partner, and your legal counsel, which makes a whole lot of sense in terms of deal structure, I can imagine. But do you round out your core team with folks that are in-house that it just happened to not be on the site? Or do you actually use consultants, folks that are involved in the day-to-day heavy lift of pre-development? Is it all consultants? Not necessarily the architects and engineer side. I'm saying more of the development, development associate, director of development, those types of activities. Do you keep those all between you and your partner and your expertise, or do you farm them out, or do you have other people that you employ on a long-term basis?
And Glenn, good. Did we meet? We met, didn't we, in Miami? Were you at one of the real estate executive council activities?
Yes, we met at the NAOP conference, and Ken, and then Reese had a evening session. So
yes.
Absolutely, good to see you again.
All right, same. So the short answer is we have a core team, and I won't say we'll use consultants, because then people, capital wants to see you have all this skill and expertise and resource in-house, right? And that's code for, I need you to spec $2-3 million a year, right, in overhead and carry costs before I go forward, right? And from a risk management standpoint, right now we have a pipeline of 3 construction starts this year. Like I said, 803 units, and we're able to manage that ourselves in the earlier parts of pre-development. To deepen your question, because everyone gets around to that in terms of not dropping the ball, there are 2 pieces. One is on the architecture and the construction side. It's not just an architect and an engineer. Now our partners are Niles Bolton Associates there in Atlanta, and Clark Builders Group. They're the 5th largest GC of multifamily. But what's really key in there is that these guys have done 26 projects together, and so we're taking more of a design build approach and interaction, as opposed to you pay an architect to do the plans, then you pay and then the contractor goes and bid. So they are an integral part of the team. The other part is we have what I guess you could refer to as consultants, but what we've done is white label other shops and then have their people, where they're carrying that overhead, supply the project management and construction management, with the construction management to start at construction loan closing. So we have synthetically put those pieces together, as well as on the reporting, development, accounting side as well, because obviously that's, people are trying to make sure you can check all the boxes and execute. So we put that package together, and then that package is now available for other folks that have $80 million projects to do, and then we can just wrap those pieces around it without where we can expand it and contract based on the opportunity that's in front of us, as opposed to having to carry like I did in the early 2000s, where it carried a bunch of people, and you don't get the deal flow, and you're carrying people. It gets tough real fast.
Yeah, thank you. That makes a lot of sense, and it allows you to be hyper effective and also stay lean. And it did just cross my mind. Not only did we meet at the conference, but we had dinner together, and realized we had some acquaintances from Ithaca as well. So
that's right.
Right on. All right, we'll talk soon. Thank you, Joe.
All right.
Well, yeah, Glenn. Thanks. Appreciate you being here today. Oh man, so that was good, Charles. A lot of good points. A lot of good points there. And it's always interesting to see how individuals are able to go from, kids in college to doing big productive real estate deals, and
Right.
that's where it's at. And the challenge of having to navigate the lack of liquidity. Even as you mentioned, you had to tap your parents early on to kind of get going, but at least you did it right and were able to build on that momentum in order to get into some other projects. So that's a good thing.
Yeah, and I'll add to that, right? So hey, look, back to Glenn. So we're alphas, and Vernon Woodson Tandy was one of the first Black architects. He actually designed Madam C.J. Walker's house, right?
Okay.
I do pay attention to this stuff because I think that the built space is a large part of our community, and I think entrepreneurship, i.e., C.J. Walker, is a core to that. So one of our current probably wealthiest entrepreneurs, Robert Smith, he was clear on that capital side, right? So he went into technology because it was the most scalable business and not capital intensive. But real estate, flag capital intensive. But there are mechanisms for raising capital. And so the key becomes understanding at each stage, how do you appropriately match or go to the right pond for the right capital? There are $50,000, there are $10,000 checks, there are $100,000 checks. There are $2 million checks, and then there are $30 million checks. Mm-hmm. And those tend to be different people that write those checks and different motivations. And so it just becomes, skilled at putting the capital together, or they can call Joe Miller.
There you go. That's the easy way.
Right.
Yeah, appreciate that. But good point. I mean, that's really what it's all about. And, you've been able to do it. So I think it's a great example, a great testament that, it's not that a lot of other folks are smarter. They just have greater resources that sometimes we can't tap. But creativity coming into play, you can figure out ways to get things done.
Hey, I was going to tell you that too. So when we were wrapping this box or suite of products and services around deals, a white guy says, and I said we were doing it because a lot of times Black folks are undercapitalized, don't have the capital. He said, "Hey, Charles, white people don't have the capital too a lot of times." and so I've been reminded on a number of cases, right? Even someone at the largest development shop in the country, multifamily development shop, he's like, look, I can't go out and raise capital, just go out and raise $5 million of money, and it's hard. But by listening to the roadmap and identifying that, those buckets are out there, and it's just putting the pieces of the puzzle together.
Yeah. And I think you've done a great job doing that, but it is a roadmap, and you got to follow it. So I appreciate you bringing that out.
The other point I'll mention is time. That always comes up, and I think it's underappreciated. Living in Tallahassee, where I had a house with 2 roommates, meant that my living expenses were less than $1,500 a month. And so on $1,500 a month, you have time, a year, 2, 3. Where if I were living in like a lot of my peers that were in New York or Washington, D.C., or back home in Chicago, then I would not have had that time because those expenses are clicking much faster, and real estate takes time. And so that's the other part. I think entrepreneurship, period. But I think that's a big factor people need to consider and be aware of.
Yeah. Time and managing expenses, as you alluded to earlier. So very good point there. Patricia had a question here in the box. Let's see. My question is, to what extent do you work with CDFIs and leverage affordable housing programs for your development? And to what extent are you involved in affordable housing development, percentage of your projects? And what are the kinds of returns do you need to see there compared to market rate development for it to make sense for your company and its mission? So sure. A lot of information there. Right.
No, actually, I can synthesize it pretty effectively. So all of these, let's just use $75 million, and somebody's got to write a $25 million check. So you're just solving for the $25 million check. And on a market rate basis, people who have those checks who've raised, $1 billion, $3 billion, and their job is to invest those 25 million checks at a time, they are looking for high teen returns, 18 plus minus, and they're looking to double their money over a 4-year period. The workforce housing or affordable housing investors are lower to mid-teen. So instead of calling an 18, they're looking for a 13. So that's the difference. CDFIs work with financial institutions, and then those financial institutions become, sometimes lenders, et cetera. We have not. We tend to approach things on do the market rate first, and then add the enhancement or other products. There was one transaction in Kansas City where it was already mandated that in exchange for the land, that 20% of the units had to be affordable. Affordable meaning 50% AMI. And so that does qualify for the tax credits. We brought in an expert to do that. And then for one in Houston, Texas, we did capitalize on a tax abatement. But we start with underwriting on the market rate side and then back into the affordable. But I try to stay out of what I'll call the affordable soup of affordable housing finance, where you end up having 10 plus different sources for one deal that is not efficient in a housing production business.
Yeah, very good point. And just to mention, AMI, just to define our terms, is area median income. All right, for those of you who may not know. All right, so that sounds good. Patricia, hopefully that answered your, okay, she said great, thanks. So very good, very good. Well, Charles, as we kind of come to the end of our discussion today, we certainly appreciate all your valuable insights and the time you spent with us. What would you say Gateway Merchant Banking is going to look like in 5 to 10 years? What's your vision?
The vision there is we're doing 4 multifamily market rate per year, and then we're doing 3 plus minus workforce housing per year, and we are, well-oiled machine in the housing production business.
Okay.
I think that the United States and many markets, excluding the cities where the population is exiting, right? I think we're going to be chronically undersupplied housing structurally for a period of time. And so I think that we will be a participant in that and creating great product and, making investors money and getting the built space built by us. Okay.
All right. Well, sounds good. That's an excellent note to end on. So we appreciate it. And thank you for all your valuable insights today. Next time I'm in South Florida, definitely plan on catching up with you. Now
all right.
At your home. So that'll be a fantastic thing. And any concluding comments for our guests today as we wrap up our discussion?
Nope. I'll just say supply, demand, and performance. I think that's it. Church yesterday was about, believing in and not letting self-doubt mess you up. So I think that those are critical pieces. Self-doubt can erode, and talent that finds demand, supplies it, and performs, it works. Don't have to get distracted by anything else.
Yeah. Very good. So appreciate that. All the fine comments coming in the chat. We certainly appreciate that. And certainly appreciate you guys being here today and participating in our discussion. So, Charles, again, my friend, it's been a long time, but good to see you as always. You never age, man. I see maybe a couple of gray hairs.
Please. The hair is thinning, and yes. Time is flying. Look, I appreciate this. I wish there were more times to do it, especially in person. Really appreciate the guest questions and interacting as well.
Absolutely. So this has been the Mornings with Joel CRE podcast. We're very excited to have you. We thank you again for being here, and we look forward to having you with us next week as well. Thank you so much.
All right. Thank you all.
We appreciate it. Okay, everyone. Have a great afternoon.
You've been listening to Mornings with Joel, commercial real estate podcast, where we focus on rising stars and established players in commercial real estate and talk to them about how they are building legacies in today's marketplace. Please check back weekly to hear our upcoming guests.